Meet Sylvia Ho, a lawyer who's got the legal info that business people need to know.
So welcome to my office. Today, we're going to interview a banker. And what a banker. I have Jake Dozer here from Key Bank, and Key has relationship managers, and Jake is a relationship manager. And he also has relationships with business owners. So welcome, Jake.
Thank you for having me, Sylvia. I'm looking forward to it.
Oh, good. Well, before we did this interview, we had a very long discussion about the different issues with business owners, and I'm hoping that we can cover some of them and answer some questions, because I constantly get asked questions and also hear comments from business owners that are not true on financing. And I'm hoping that we can help some of my clients and some business owners understand the relationship of banking and lending to business, and how bankers and lenders can help, and how to develop that relationship. So as they grow, they have the resources that they need to grow their business and support themselves and their families. So thank you very much. I'm really glad that you did this. I've been looking for a banker for a long time.
Well, I'm looking forward to it as well. And I'm looking forward to learning from you just as much as hopefully we can help anybody who watches.
So what is a relationship manager at a bank? I know you're a relationship manager at Key Bank, but what is a relationship manager?
So, I would probably describe a relationship manager in a comparative sense, meaning oftentimes we think of somebody at a corporation doing one job, and a relationship manager really serves as a facilitator for multiple solutions and services that industry provides. So specifically for me, what I do at Key Bank is I'm going to be able to sit between multiple resources, multiple channels within the bank, and be able to facilitate how each of these things sort of flow together, and how they, in a holistic sense, can help a client's sort of financial path moving forward. Because oftentimes, as much as we try to target the issues that we might be facing or the challenges that are presented to us, they have a lot of overlap. It's not a perfect, it's a false dichotomy. It's a Venn diagram of sorts. And so that's how we work is we're taking A and B and C, and how do we put these together and put a package together in a relationship and launch a client in the right direction.
So I get the sense on the Venn diagram that you're kind of the hub of the client facing the bank to try to solve their problems with all the resources that the bank has for the business owner. Would that be a fair way of describing it?
I think so, yeah. As opposed to coming in and saying, I have this problem specifically, can you give this to me? It's more of coming and saying, hey, this is what's going on. What's your diagnosis? And then bringing in the appropriate wheelhouse of product solutions, partners, and being able to solve it sort of in a synergistic way.
So we're going to talk about two very common scenarios that almost all business owners face.
Sure.
But before we go through that, I noticed that you are a Key for Women certified advisor, and I hadn't seen that. I represent a lot of women business owners, but what is a certified advisor, and what is the Key for Women program?
Yeah, it's an exciting program. Key Bank launched an initiative, and it's not a recent thing necessarily, but launched an initiative that is for the advocacy and empowerment of women business owners and entrepreneurs, young professionals, creating a space for networking, for education, for equipping women with who maybe their business in general, things that might come up, but also maybe unique challenges that women might be facing as business owners. And so as a certified advisor, my role is to sort of understand that program, understand the capabilities that it equips women business owners with, and be able to connect people a little bit more frequently than they may see outside of that space. So most often it's looking at Key for Women sponsored events in the area where we're bringing in maybe a panel of experts and talking about different things and being able to provide education and resources around those challenges. Maybe it's just providing a networking group. Maybe it's providing connections in the community so that you can feel like you're not an island and getting support. So it provides a lot of different things, and definitely always looking forward to speaking about it.
That's great. I mean, women business owners at this point, they were the fastest growing segment of businesses, but at this point, women own a large proportion of the businesses out there, and it's a real challenge every day as a woman, many of them moms, many of them getting started out, to be able to find those resources. So I'm glad that you're a certified advisor and there's a program for that. And I think that you also talked about procurement, right? Key also reaches out to women businesses and offers them the opportunity to bid on certain things. Is that right?
That's right. Thank you for reminding me. Through our Key for Women program, people who are participants can actually submit applications to become sort of a vendor or a participant with KeyBank in different things. And both women-owned businesses, minority-owned businesses have a sort of a unique opportunity to be able to do that. And that's just kind of one of the many things that that Key for Women does, but it's really not exclusively that. I always like to emphasize to people like, hey, this isn't exclusively a members only, we're trying to get you to bank with this type of thing. It's more of, you don't have to be a KeyBank client per se to be able to connect with this group and get the resources that will propel your business forward.
That's great. I'm definitely going to send you a couple of women business owners. So let's just delve into what a banker can do to help a business owner. I think that most business owners think of banks as two things, right? I put my money in and I take it out. And so that's one. The other one is I borrow money. And that's it. That's the sum of all of your relationships with a business owner. And so I think that there's a lot being missed here. So why don't you talk about how a banking relationship can help a business owner?
Sure. And I think that you're right. I think that I think that society tends to become transactional by nature, in the sense of like, hey, I go to the bank and I put money in and I'm expecting interest, and I take money out and I'm expecting to pay interest. And I don't really know how all of it works. So I'm always keeping this skeptical eye on the situation. And I understand with money, there's always this sense of very sort of this nervousness around what does this all mean and what are the ramifications of it and all these things. But I like to think of, especially in my role as a relationship manager, doing my very best to be an educator and an equipper and somebody who can serve as an advice center. So as opposed to, for the sake of illustration, as opposed to going to the doctor and saying, hey, I'm here, this is my problem and I need this prescription. It's more of going to the doctor and saying, hey, this is what's going on. What should I be thinking about? And then, sort of throwing lots of questions at you and asking different scenarios, and then putting together that information and saying, okay, well, based on you saying this, this, and this, and my background and knowledge and expertise, I'm going to prescribe you this, and this is why. The patient doesn't come in and say, well, hey, I did all my homework beforehand, I know what I need exactly. That's not to say that people shouldn't take ownership of their financial futures, by all means. But what it does mean is that the appropriate relationship with a bank can serve as sort of a whiteboard experience to say, hey, this is what I'm looking to accomplish. Help me make sure that I'm not thinking inside of too narrow of a box so I can solve this problem, or tackle this challenge as effectively as possible.
So let's begin. So I'm starting a business. So this is a very common scenario of how I'm thinking about starting a business. I haven't started one yet. I haven't opened an account yet. Is that a good time to go and talk to a banker?
I would say not only is that a good time, that's probably the most critical time. To use that hub illustration, a bank is sort of a launching point for a lot of different avenues. I talk to clients all the time. In fact, I'll use an anecdotal situation. I spoke with a client who was looking to get a business off the ground and was recommended to come see me from a group that I connect with, and didn't quite know where to start, had some ideas, had a great vision for what the business would look like, and knew, I know that there's growth opportunity here. I just don't really know where to start. She started listing some of the things that were concerns, and I was able to say, both under the roof of KeyBank and also outside of the roof of KeyBank, being able to say, hey, here's 1, 2, 3, 4, 5, whatever it is, resources that we can launch you. You're going to need a checking account for day-to-day operations. You're going to need a savings account for a myriad of reasons. You're going to need a cash flow solution. So we're going to be looking at a credit card for effective and safe spending habits. In addition to that, I want you to meet my business attorney contact that's going to help you choose the right sort of formation and all these different ideas for growth. And I had introduced you to her to you. There's another attorney that's going to be able to help you with intellectual property because there was a unique challenge that she was facing. And so once again, it wasn't necessarily just internally with KeyBank, but because of what we do, we invariably interact with other professionals, even outside of the scope of Key, where they're appropriate. And far be it from me to keep my advice exclusive to what I can offer. I'm going to be able to pull the resources and professionals in that have expertise outside of my scope. And that's what we want to do with clients.
So when a startup comes to you and they are looking for, say, they're going to be needing space, they're going to be developing something that is going to be generating income for them that will grow. And so in terms of the financial pieces of it, what is it that a startup needs to know when going to a banker?
Great question. I think a startup needs to realize that a business is an investment and that growth and maturity of that business doesn't come overnight. And so they need to understand what is that investment going to look like in terms of time, in terms of finances? How is this going to factor in with my personal finances? And then also sort of have a vision for the future that says, what do I want this business to look like in 5 years? How is the financial situation going to change? What are my projections of revenue? What is my cash flow going to look like based on the industry that I'm in and based on how long it's going to take to get there? So really it's understanding where I'm at, being realistic with myself and how long it's going to take to get there and what that investment truly is going to mean for me personally. And what do I want this to look like eventually? Having a vision for the future. Because if it's too high level, it's too ambiguous, you don't have a target to shoot at. So that's really understanding those two bookends of the story.
I'm really glad you talked about that, because we also talked about being prepared for the future. And a lot of times, and I think I say this often, that growth is a very dangerous part of a business, because when you start up, you don't have much overhead, but when you are growing, you're just sucking up that resource, that money that you need in order to get there. So there are two parts where banking and danger and credit plays a big part of being in business. And if not planned properly, a lot of businesses end up with not being able to provide what they need to meet the needs. And then they get in over their heads at that point. So there are two parts I want to talk to you about, which is building the credit so that when that happens later, the business owner is is prepared for that growth and has the resources, the financial resources, the borrowing that needs to grow. And then the other part of it, so we're moving farther down the line with a mind toward being a more mature business, say 5 years down the line, or 3 years down the line, or 18 months, or some businesses as soon as probably 6 or 7 months in, they find, oh, I need to buy a building because now we're bringing in so much money and I need to hire more employees. I need to have a bigger space at that point. But at that point, I don't have the credit to borrow. So what can we do about that so that we have our business owner at the beginning so that when that happens, she has the resources that she needs? How can you play a role? How can the relationship with the bank play a role to that time frame where we're able to get our needs met to grow our business?
Sure. I think that you made a good point, is that from startup to growth to maturity is an ever-evolving process, and sometimes it's fast and sometimes it's slow. I think ultimately, to tie that idea along with that investment idea that I mentioned before together, typically you have to keep in mind that if you're investing a large amount of capital up front, you're going to be able to grow faster probably. But if you're not, you're going to probably have to invest more time long term. So it's typically a one or the other. And so with that come different challenges on both sides of the same coin. But ultimately, it comes down to that planning piece: is how well have you planned and mapped this out? What type of knowledge do you have up front that's going to be able to propel it forward? Oftentimes businesses, and I'm sure you could attest to that, is, hey, if you're a restaurateur or you're a chef, you know the kitchen inside and out. That doesn't necessarily mean you know the numbers inside and out. And some of us are gifted in both of those areas. I will be the first to confess I am not, and vice versa. And so understanding the commitment factor, understanding the planning factor, putting the right, I think this is needless to say, with the context of the audience, I would assume that's watching this, is understanding the value of working with the right professionals. Because I don't pretend to know the first thing about plumbing, but I am also the first to call the plumber when I need it, because I understand the value that they bring is the education. And so I think when you understand those things conceptually, the next thing you have to realize is the progress of this financial freedom that a business can be birthed into starts typically with leveraging yourself personally, whatever that looks like. Maybe it's an initial injection of cash, but oftentimes it's a business owner looking at leaning on their own credit. Maybe it's taking a personal credit and then some way to fund the business or to lend the business the money. Also, eventually getting to the place where you're guaranteeing a loan, understanding that the business will take the loan and you as the owner or the manager or the member, however you're set up, is going to be a guarantor behind it, saying, hey, I stand for the business in the event that the business itself cannot get off the ground and make the payments. The next step invariably is looking at asset-based lending. Most commonly, you're thinking about a mortgage, you're thinking about real estate that is collateral to back that loan. Maybe it's assets in the form of cash, maybe it's assets in the form of accounts receivable, and then eventually getting the business to the place where it's fully beyond that and be able to do unsecured lending. Obviously, it's a spectrum. It's not an A or a B, and there are times and places where all of those things make sense. And one of the biggest factors in playing where that makes sense is people watching your previous interview with Matt Turini and understanding the different business structures and what the implications of those structures are. And that goes back to that planning piece of how my personal involvement or lack thereof plays in the growth of the business in the future by way of payment and involvement financially. So I think it's that planning piece, understanding the natural progression, but understanding that you as a business owner and the business as of itself are not mutually exclusive entities. There's always going to be some sort of tie.
Right, at least with regard to credit, until you get to a point where you have multiple shareholders. And even though I think people are very surprised when they go, well, I went to the bank and they want a personal guarantee. And I said, yes, and your assets too. And then they go, well, I don't want that money, but then they can't grow. It is a choice though. But for those who do want to have that relationship, right? I think the very lowest, the easiest form of lending is the line of credit on the business. So I need to hire 4 more people and I have them on my payroll because I'm going to need to move that. And I'm pretty sure that this guarantee is not going to affect me because I'm going to pay it right back. So how can you, what, talk about a little bit about that part of the process? Because I think that from the point of view of a business owner, that would be their need. I really don't think that at least more experienced people are going to say, I have this great idea. I'm just going to borrow money from the bank so that I can live on it, so that my big idea is going to take hold and the world will recognize it. And I think that that's actually something that at the SBDC, this Small Business Development Center, spend a lot of time talking to people who are interested in business, opening a business about, no, you're not going to borrow money so that you can live on it, so that you need to present us with a business plan, right? You need to be able to do that. So in the growth stage though, we do need capital and we do have a problem. So one of the most common things that people do is they look for a line of credit to fill that gap. And so they're growing their business. And how will that say that business owner came to you as a startup, groomed their personal credit, right? And had a good credit history. How would you help facilitate that whole process? And when is the optimal time to facilitate that or to create that relationship so that that process is facilitated easily without the need for a lot of checking?
Yeah. No, I think that goes back to the piece about when does the question you asked, when does a startup need to develop a banker relationship in its startup phase, or even before that, to be honest. And that's true with lending, and that's true most specifically, to your point, with lines of credit. It's probably one of the most foundational pieces that a business can lean on. A line of credit is going to be flexible conceptually, and I'm sure many of your listeners know this, but you're only paying on it when you need it, essentially. And so how powerful is a tool like that? Because when I don't need it, I don't have to pay. Maybe there's a small annual fee or something like that, by all means. But in that sense, it's almost a sense of insurance. Is like, hey, I've got this backup, a cost-effective line of credit to lean on when I need, and when I don't, it's there for me. It's going to be able to help most efficiently with cash flow. Are you a seasonal industry where you're having these ups and downs? Is it a payroll-induced cash flow where maybe you're in that place of the business where you're having to front the cost for employment and you're slowly sort of paying the business back over time and using the line of credit less and less? But invariably, it's something that everybody should consider, and the sooner the better, not in the spirit of encouraging overutilization of debt, by all means, but in the spirit of putting something in place before you need it, because when you need it, invariably is when you don't qualify for it.
Right. When you need it. That was the joke. We were talking about that, especially with the fintech lenders, when they realize that especially with seasonal kinds of businesses. So they come to you a bit. So I'm a business owner. I come to you. I don't need it yet. I'm going to apply for a line of credit. You're going to do my personal check on how I'm doing. And oftentimes my credit is best before I start my business, because at that point, maybe I was an employee, right? And I had a great credit score. That's a good time to get one. you're going to be a backup. You're going to guarantee that line of credit yourself, but then you're getting that because of your personal credit score when you start. And then when you need it, you'll be able to draw on it. I mean, so many times I think that is one of the reasons that businesses start to cave in, because they don't have enough money to purchase the inventory that they need, the components that they need. And we're talking about small businesses. We're not talking about big ones, because once we get much bigger, then you have many more assets. You have accounts receivable, you have all sorts of things. So we're only, just to be clear, we're only dealing with that entrepreneurial process. And then banks, of course, are not the only places that you would go to get your funding, right? There are angel investors, and there are also other investors, and then there are also venture capitalists. But what are typical types of customers that you would see with a line of credit? And then I'll contrast it with venture capitalists.
Sure. Oftentimes the clients that I'm seeing most often with lines of credit are going to be, to your point, not necessarily the startups, because oftentimes we're looking at building credit and we're looking at setting things up in that stage, but it's going to be the business who maybe they're looking at, maybe it's the electrician that's adding a new truck to get on the road this year. And they're saying, hey, I need a new truck, and I know that this is going to result in, X amount of dollars in an increased gross revenue over the next couple of years, and it's going to allow me to, take a step 1 and 2, and I've got another employee coming in with that truck and all these different things. Maybe it's the business that knows that I'm thinking of a company that delivers oil, and they've got these high highs and low lows. A lot of times it's the contractors that I'm seeing. Maybe it's to finance a project or to buy inventory in bulk that they don't have a specific dollar amount set on. So, hey, I know that I'm going to need to buy, $20,000 worth of inventory right now. But I don't know, is it going to be 20? Is it going to be 30? A line of credit is going to be appropriate. And maybe it's sort of a flex line, which I don't want to get too in the weeds with different products, but where it's a line of credit for a certain period of time that converts into a fixed loan. So I'm thinking of a business that has 3 or 4 vehicles, and they know that they need to replace those vehicles over the next 5 years, but they don't want to have to take separate loans for each. And they don't know quite when it's going to happen. So we're going to put a line of credit that is good for 3 years, and then it converts and turns out into a 5-year loan. So it's more comprehensive and more flexible for them as their needs arise.
Oftentimes, I think people, when they get to a point, talk about fixed loans, they think about SBA loans. And oftentimes I get asked that question, and I say, well, maybe you shouldn't think about an SBA loan. And I get this quizzical response that SBA loans are the only loans that are available for small businesses. And oftentimes they don't start with a bank. So number one, should they start with a bank? And are there alternatives to SBA loans? And who's a good candidate? What is a good candidate for an SBA loan versus another loan? That's a mouthful.
Sure. So I think first and foremost, I'm glad that you say that to clients, that I'm not surprised. SBA loans they serve their purpose, but once again, they're a tool. They're a prescription, and then they're not really the first level, which is the prognosis, right? So I think this goes back to, not to keep it too high level, but it goes back to seeking out a specific product as opposed to enlisting a professional who sort of can understand the lay of the land and give you a product that is appropriate for your need, as opposed to seeking a product specifically. Because otherwise, why have that financial professional in the first place? Lean on their experience. That's what you need to do, as a business owner. But specifically when you're thinking about SBA, SBA is going to be the Small Business Administration, and it is SBA-backed loans, it's guaranteed loans. So because of that, we know that the reason the guarantee is needed is because maybe the credit isn't great. Maybe it's an industry that a traditional like bank wouldn't lend to because maybe there's additional risk or it's outside of their risk appetite. Or maybe in a positive light, there is a specific program that the SBA offers that a client or a business owner can take advantage of. That's really unique and great. I'm thinking of if you want to relate it to like an individual personal side of the house, like a first-time homebuyer program. Well, a bank might not have something that's super unique like what a state offers. Well, why wouldn't you lean on a program like that? But concurrently, you wouldn't go to a first-time homebuyer program that's specific to a state or something like that for a conventional loan after you own your first home. So that's kind of the same concept with an SBA loan is it's going to meet certain needs, but not everybody needs it. And they surely should explore the options that a bank provides, because oftentimes you can find maybe more flexible terms if the credit or the finance or the industry is in the right place. And I also would like to just mention, I think a lot of times people get nervous about guarantees or personal guarantors. It's not necessarily bad to have those. And I understand the desire to keep things separate and you don't want to be on the hook, so to speak, for something that the business has. But at the same time, I think it's understanding that relationship and understanding how the two things play together on a large scale. I understand, so once again, to relate it to personal banking, people oftentimes are so fixated on paying down a mortgage, for instance, and oftentimes it's a mental victory, and they're so excited to put extra principal on the payment. Well, I think about today's mortgage environment and rate environment, so 3% maybe for a mortgage. So here's a contrary idea. Why spend so much time focused on paying such a low interest rate loan when the opportunity cost of your money could be growing substantially higher than that, or it could be put to use? So similarly with a business owner, don't be so quick to reject the idea of a personal guarantee when that personal guarantee may be getting you more favorable terms than without using it. So that's kind of speaks to, I think, the fact that people need to enlist and sort of have that whiteboard experience of looking at all their alternatives when they're looking at financing.
Yeah, it's kind of interesting. You kind of make me sort of tempted to make a video on personal risk. I'm doing a course on personal liability, how to protect your personal liability. And I don't think that people know enough about where those liabilities are, and they just assume that it's because of the guarantee. Whereas if they're underinsured, they're personally liable. But then if they have a personal guarantee, they might not have much of a risk because we're not talking about much in lending, or there's enough cash flow in it, or the business could be a very thriving business. Plus there are exemptions for your homestead and other things that would protect you depending on what your assets are. But people are, just like you said with the mortgage, people have certain rules of thumbs based upon certain impressions that people keep repeating over and over again. They think it's true for them. So I know that when you come in and you borrow from a bank, from a business, you would want to see a business plan. You would want to know something about the business. So what is that process in terms of applying to a bank as a business owner when you're looking for financing?
Sure. So typically when a client is looking for financing, I would encourage them to always check with the bank with which they bank on a regular basis. I'll keep it high level, but credit for businesses versus the consumer side, there's very understandable systems in place, and that is not true on the business side. And so a lot of times there's a lot of value in the relationship and where you have that relationship. And so even beyond that, though, the process is going to be not too dissimilar to what somebody would expect with a personal loan, in the sense of we're going to be looking at income statements, we're going to be looking at revenue, we're going to be looking at profit and loss, we're going to be looking at tax returns, we're going to be looking at, depending on where the stage is, business plans, wanting to understand corporate resolutions, partnership agreements, what's the entity, what's the registration look like with the state of Connecticut or wherever your location is. So understanding the ownership, understanding cash flow, understanding income, what does the future for the business look like, and understanding the need and fitting it appropriately.
And then you look at all your products.
Absolutely, yeah.
I think one of the things they do is, well, send me an application for an SBA loan and I'll fill it out. And that you could do that, but you'll end up costing you a lot of money. And there are all sorts of regulations that go with SBA loans that prevent you from doing what you want to do much later. And if you have a long-term SBA loan, that could really hinder your growth because you can't take in other investors.
Right. Well, and that kind of goes to the point of, I think it's critical when people are looking at making major financial decisions, specifically lending, is to be able to articulate what you're trying to accomplish, to be able to cast a vision that both you understand, but also the potential lender can understand, and being able to paint a picture around that, and then being forthcoming. And maybe forthcoming isn't the perfect word, maybe being all encompassing, meaning lay out the situation. Don't, well, here, I'm going to paint this picture because this is all I think that you need to know. When oftentimes there are other factors that maybe you haven't considered that will help that person be able to most clearly articulate or help you articulate what you're looking to accomplish. And then they're going to be able to sort of explore their menu of solutions and products for you and be able to say which one's going to be the best. For instance, just as a quick example, I have clients come in all the time for consumer lending, and maybe they'll say, "Hey, I'm here for a pool loan because KeyBank does unique pool lending." And when in reality, we can explore maybe a mortgage refinance that they didn't even think about the fact that their mortgage interest rate's too high, and oh, they also have the cash equity available that we could wrap in the project for the pool, and now we have accomplished two birds with one stone, so to speak. And that's true on the business side as well. While there's power in a line of credit for a business, there's also sometimes, if you have a very well-defined purchase that you need to make, a much more appropriate specific type of loan for that purchase. And so it doesn't mean that the two things cannot work in tandem. Ultimately, don't come in with blinders and siloed on one solution when there is a product of menus that, frankly, you might not be aware of.
So that's a really good time to I have one final thing, which is,
Sure.
how do you develop credit? So one of the most common scenarios is, I'm a business owner. I am going to sell my business to an employee now. But my employees never owned the business. He's never owned my business. So maybe I'll have a installment sale with the employee. But my employee needs to buy me out. Is that a good time for the employee to develop a credit? I mean, how would you treat that versus a startup? And how would you help that employee sort of move along that purchase? And I, as a business owner, can get out, and this business that has been part of the community for many years will continue to exist and serve the community.
Sure. That's one of those times when the emphasis once again needs to be on the preparation and planning piece. The time to build credit is not when you need it, it's beforehand. And so this is true really of all of our clients, regardless of type, is encouraging healthy and regular use of credit. So when I say regular, I want to stress healthy. So don't get into debt for the sake of building credit necessarily. But most commonly what you'll see there is, hey, let's get a credit card or 2 or 3 opened, and let's start using them regularly. I didn't say carry a balance, pay it off right away. So practically, let's make a regular purchase and then pay it off immediately. You don't have to carry a balance, but show that you're using it, because behind a credit score, which is what a lender is going to use to judge your borrowing ability or their comfortability with your borrowing ability, is a credit file, and comprised inside of that is the different history that you have with different lenders. So a client with a credit score of 780 that has had one loan in their past is much different than a client with a credit score of 780 with 10 loans in their past. Both can produce the same score, but both are very different as far as a borrowing perspective. And banks don't just look at the number. They typically are going to look at least one of the bureau's numbers. And then on top of that, they're going to be looking at your debt to income. And then on top of that, they're going to probably build their own internal score that they don't share with you that helps them articulate what your risk is. And then they're going to look at your propensity towards bankruptcy based on these spending habits. Banks are in the business of lending money, and so they're pretty good at articulating risk. And so that's the thing that I think is a great preparation thing, is looking at what does succession look like with my business and spending time with a good business attorney, hint, and succession planning.
I think I think that it's a great service for business owners to know that, because a lot of times business owners know who their successor is and want that to be facilitated. So the earlier you can put an employee in that process in terms of credit and in terms of borrowing, the easier it will be at some time in the installment sale for that employee to transfer that business. So many businesses are not sold; they just fold, and it is a shame, because when they fold, employees lose their jobs, and it becomes a disservice to the community. So I think the takeaway from this interview is start early, get to know a banker, right? Ask lots of questions, throw some scenarios out, develop a plan with your banker, do some research, and keep your relationship going, and work a plan to develop your credit. And then when that need comes, you'll have that line of credit to grow. And if you're going to sell a business, and if you're going to be the buyer of a business, start early. So I guess the takeaway is start early.
I think start early and start often. At KeyBank, the mantra that we sort of fly under is financial wellness. Regardless of what we're doing, whether it's proactively recommending a solution or product, or it's reactively responding to a situation, we want to be propelling a client's financial wellness journey forward. And so we facilitate that through consumer and small business financial wellness reviews, where we go through a regular process of understanding and evaluating where a client is, where they want to go, and how we can facilitate getting them there. Through the process, we assess where they're at. And then we regularly check in, typically every 3 to 6 months, even if things really haven't changed, but to reestablish a connection and say, hey, have you thought about this? Are you thinking about this? How are things going? And then we typically summarize that conversation with both behavioral and product-based solutions that say, hey, because of all these pieces that you've said, we want to help you tell that story by giving you behavioral recommendations and things you can do, and product recommendations, ways you can carry those solutions out, and how to move yourself forward. And so I think that start early, start often, and plan.
Okay, great. Well, thank you very much. This was pretty thick and kind of scary for some business owners, because they're in the thick of it now, but they're always welcome to come and talk to you, right, Jake?
Absolutely. And we'd be happy to send them in the right direction.
Do